I'd like to thank everybody for joining us today. Today, I want to talk about helping our business owner clients understand their options when they're funding their buy-sell agreement. If you think about buy-sell agreements, um, every business owner, if you present the ideas, should understand they need a buy-sell agreement. Now, the question is, how do they fund the buyout of a partner when one of those triggers happens? Part of this is understanding first what type of agreement they have. You can have a cross purchase agreement. Well, if we have a cross purchase agreement, the funding has to be between the business owners. Since the business isn't part of the agreement, each business owner has to be prepared for that buyout. So, do they have the money to, if that trigger happens, to be able to buy out their partner? If it's a redemption agreement, well, now the business has to have the money to fund that buyout. And of course, now we can have a hybrid agreement, which it could be a cross purchase, it could be a redemption agreement. The remaining shareholder gets to decide how that's going to happen. But there again, the document is the contract. The document says what's going to happen as far as the mechanics. But let's be honest, when we get to the how to pay for the buyout, that's where the rubber meets the road. This is one where we actually, have somebody has to pull out a checkbook and start writing those payments. And so if we haven't helped our business owner prepare for that event, now we have a cash flow issue. And that cash flow issue may be so significant that the remaining shareholder or owner of the business may have to go into bankruptcy to avoid that contract, which is the worst of everything happening. Not only has the business lost one of their partners to a death, disability, or retirement, whatever triggers happened, but now the surviving owner can't make the payments. And so everybody loses. So pre planning for this is so important to understand, can we help them create the right cash flow to make this work? Now, if I look at this, let's get a case study here because I think this is the best way to do this. If we have two 50-50 owners, John is age 50, Steve age 40. They have a $2 million company. Current income tax for them is 45%. They have the basic buy sell agreement triggers: death, disability, retirement. Of course, we want to make sure that they have all of those triggers necessary for their type of business. So when we do that buy sell review, we want to make sure, in one, that the legal structure is there. But now let's look at the payments. If I look down here at the payments, payment number one, part one, if they have any life insurance up to the amount of the sell price, that would be at least the down payment, if not the full coverage of the debt. If they don't have life insurance, then it's going to have to be an installment payment. And so typically I'll see a 10-year payout paid monthly, so 120 months of worth of payments, and there's going to be an interest rate, and 7% would be a nice interest rate in today's environment. And let's look at this. What happens if John dies? Because this is where we have to really start looking at this. Now, if I'm looking at this and there's no life insurance, now we're already pushed to where the only way Steve can make this payment, if he doesn't have $1 million sitting around, is to go ahead and use the installment payment. So what does that really mean in real dollars for Steve? Well, Steve is going to have to earn $21,110.63 per month, pay a 45% tax rate, so he can pay John's heirs $11,610.85. Remember, these payments are after tax, whether it's a cross purchase agreement or whether it's a redemption agreement. We're going to be paying this with after tax dollars. So there again, net or gross 21,000 and change to be able to pay that $11,000 interest and principal payment each month. Now, what does that mean over a year? Well, over that year, Steve again has to generate $253,000, pay the tax bill of 45% to be able to pay $139,330.20 to John's heirs every single year. And he's going to have to do that over a 10-year period. So you start looking at this. John has to earn over 2.5 million dollars to pay out a principal amount of $1 million and $393,000 of interest over this 10-year period. Now, when I look at this, I look at, hey, we have a problem here. And this problem can be Steve is now running the company and owns the company 100%. He's lost his partner, John. John, I'm assuming, was taking on 50% of the workload, whether that's management, actual work, depends on the situation. But now we've got a situation where the remaining shareholder or remaining owner of this business has to generate this money without the help of a partner. Does that mean he has to go out and get a new partner? Does that mean he has to go replace John as a key integral part of this company? All of these are cash flow issues. And so there again, if you haven't pre-planned, this is where we're at. That Steve has to generate $2.5 million over a 10-year period to pay off the $1 million of principal and $393 of interest. There again, depending on the situation, could be doable, may be a problem. It may drive Steve or the business into bankruptcy if we haven't planned ahead. Now let's look at life insurance, because I always hear this: life insurance is expensive. And life insurance is expensive compared to what? So if I look at this, and this was an illustration we ran to get $1 million of death benefit. So on John, age 50, assuming he's healthy, non-smoker, they would pay $19,417 per year for 10 years to pay up this policy. And if they pay out that over a 10-year period, $194,000 in premium, they're going to have, Steve will have, at the time John passes, $1 million worth of death benefit. And if you look at this, there's also cash surrender value in this policy. There again, what if? What if John doesn't die, but what if John actually retires or wants to leave early? There again, it creates the what if, but the goal of this policy design was to create that death benefit. Now I look at this, what is the real life insurance result here? Because we didn't say when John dies. We just said that John dies in our sample case here. Well, what if John dies in year one? Well, the total premium paid is $19,417 to generate that $1 million of death benefit. So, if this case, you look at the result to Steve, Steve actually paid $19,000 in premium and had that death benefit when he needed to pay off John's family. John's family's, they're taken care of. They got the payment they needed, whether to take care of whatever needs they have ongoing. Steve now has bought the company out with the life insurance death benefit and doesn't have a drag on cash flow. And with cash flow can help, maintain the business, replace John as a key man in the business, whatever that is, it can go forward. If I look at this, if John died in year 10, well, the total premium paid over a 10-year period was $194,170. That's the total cost for Steve to be able to buy out John's family with the $1 million death benefit. If John were to die in year 20, there again, we bought a policy where that death benefit is paid up, and over a 20-year period, there again, we have a total cost out of pocket to Steve or to the company of $194,000. There again, taking care of the family, taking care of Steve as the remaining shareholder, and provides continuity for this business without a significant upset to the cash flow of the business or to cash flow to Steve. So as you look at this, when we're talking buy-sell planning, it's not just the agreement, the type of agreement, that does matter. The triggers matter. But then where the rubber hits the road is, how do we pay for that buyout when it happens? And is life insurance a good fit? Does it cover, help us cover some of these needs? There again, protect the business so that the employees are taken care of, the owners are taken care of, and the family of the deceased owner in this case is taken care of. So I appreciate everybody getting on. If you ever have questions, feel free to reach out and we'll talk again next week. Thank you.